our view was a mild recession for this year. But since then, if we look at all the indicators we see, we probably see a risk on the upside. So we're looking at something that could even be no recession. Now, there are significant risks in all of that. And those risks are, we don't really know how the war is mapping out. There is always a lag in the impact from raising rates. And so we don't know exactly how the rapid rate rise will impact the economy. And there is probably one of the biggest shifts in value chains and in geopolitics that we've seen since World War II.
Yeah, when we spoke last in Salzburg, I do remember you being quite colourful on central banks and central bankers and how you felt the ECB in particular had negotiated the European situation. Do you think they're doing a good job at the moment?
I think it's a very difficult job. Europe has a different kind of inflation from the one in the US. It's mostly supply-driven on energy, on food. And therefore, what we're trying to do to tackle inflation is to jam down the rest of the demand. But obviously that has a disproportionate impact on, let's call it, the economy away from those commodities. And given the lag effect and everything else, and the fact that the European economy is quite sticky and then gives, we're concerned that if you tighten substantially above 2, it could have undesirable effect later. That said, the rumors are that we're going to have a 50 basis points rise in now and another 25, not 50 later, as we are adjusting to the new reality.
What is this new reality on higher rates doing to credit quality? It's something that you are monitoring very carefully, and a lot of CEOs are coming through here and saying, look, we haven't seen the worst effects yet of tightening financial conditions.
So it's difficult to judge because what we have is model that look at the past, and this time is different. And then we have real data that we observe. In the real data we observe, we went to December and we don't see a worsening. No worsening of credit quality, no difficulties in repayments. Actually, we've seen an acceleration. In October, November, December, there had been caution. People delayed some investments, did not take out that mortgage or did not spend in consumer. But going into December and beginning of January, we've seen a reversal of that. Not aggressive, but the slide has stabilized, and it seems that the mood is more constructive and positive.